A random walk down Wall Street number 4, a simple look at the subprime crisis. Hi, my lovely readers. I'm Miss CSPX, and I'm so excited to welcome you back to our AI Finance 101 reading series. Last time we dove into the nifty 50 of the 1970s, the US tech and real estate frenzy, the internet bubble, and the roots of the subprime mortgage crisis, seeing how wild enthusiasm can lead to market crashes. Today, we're continuing our journey through a random walk down Wall Street with a simple example to explain the subprime mortgage crisis, lessons from past bubbles, and an introduction to technical analysis. Here's what we'll explore. 1. A simple example of the subprime crisis. 2. Lessons from historical bubbles. 3. The basics of technical analysis. 4. The psychology behind technical analysis. Let's get started with today's lesson. First section, a simple example of the subprime crisis. To make the subprime mortgage crisis crystal clear, let's walk through a little story. Imagine Anna, who dreams of buying a $10,000 home. In the past, Anna would get a mortgage from Bank Bella, using the house as collateral and pay it back bit by bit. If Anna couldn't pay, Bank Bella could sell the house to recover the loan. Then, Bank Bella got creative with mortgage-backed securities, MBS. They split Anna's $10,000 loan into 10 pieces and sold them to 10 investors, Charlie. Bank Bella got their money back instantly, plus a fee. Investor Charlie worried about Anna defaulting, so they bought credit default swaps CDS insurance from insurer Daisy. If Anna defaulted, Daisy would cover Charlie's losses. Daisy was happy to sell insurance, thinking home prices would keep climbing. As MBS grew popular, Bank Bella stopped worrying about risk and loosened lending rules. Even people with no income or savings got loans, called subprime mortgages. Down payments dropped to zero. More folks bought homes and prices soared, creating a risky cycle. When the Federal Reserve raised interest rates to cool things down, repayments got tougher and defaults spiked. Home prices crashed by 2/3, leaving homes worth less than their loans. More defaults followed. The MBS held by investor Charlie stopped paying interest, and auctioned homes had no buyers. Bank Bella, think Lehman Brothers, went bankrupt due to high leverage. Insurer Daisy, like AIG, couldn't cover CDS claims, and Charlie's investments turned worthless. Leveraged investment firms collapsed, triggering the subprime mortgage crisis. If you want a vivid look at this, watch The Big Short. It's such an eye-opener. Second section, lessons from historical bubbles. A random walk down Wall Street takes us through bubbles from the Dutch tulip mania to the subprime mortgage crisis, showing how greed and fear drive markets. Bubbles always burst, and the market corrects irrational behavior. The wise Benjamin Graham said in Security Analysis that the stock market is a weighing machine, not a voting machine, meaning a stock's true value comes from its cash flow, not hype. History proves that real value wins in the long run, so let's focus on that and avoid chasing fleeting trends. Third section, the basics of technical analysis. Investing has two main approaches: technical analysis and fundamental analysis. Technical analysis follows the castle in the air theory, using charts and data to predict price trends based on market psychology, not a company's fundamentals. It's built on two ideas. 1. All information is in the price. Things like earnings or dividends are already baked into historical prices and trading volumes. Charts tell the whole story. 2. Prices move in trends. Stocks going up tend to keep rising, and those falling often keep dropping. Technical analysts believe 90% of the market is driven by psychology and only 10% by logic, which is quite different from the solid foundation focus of fundamental analysis. Fourth section, the psychology behind technical analysis. At its heart, technical analysis is about understanding how people think in the market. Picture a stock rising from $10 to $12. Some folks kick themselves for not buying at $10. When the price dips back to $10, they jump in, creating a support level that stops the price from falling further. Meanwhile, those who bought at $12 might sell to break even when it hits $12 again, and $10 buyers might cash in profits, creating a resistance level that caps the price's rise. While technical analysis looks like it's about charts, it's really about guessing what the crowd is feeling. But does it actually work in real markets? We'll find out next time. Summary today, we explored Chapter 4 of A Random Walk Down Wall Street, diving into the subprime mortgage crisis and technical analysis. We used a simple story to show how financial derivatives fueled the crisis, summarized lessons from past bubbles about the power of true value, introduced the basics of technical analysis, and explored how it taps into market psychology with support and resistance levels. These lessons help us see both the market's wild side and smarter ways to navigate it. So, how well does technical analysis really work in practice? Next episode preview. That's all for today, my dear friends. Next time, we'll keep exploring A Random Walk Down Wall Street, digging into how effective technical analysis is, how fundamental analysis works, and smarter ways to invest based on history's lessons. If you're loving our AI Finance 101 series, please share it with your friends and invite them to join our learning adventure. I'm Miss CSPX, and I can't wait to see you next time.